People are always stressed out about their credit score, but no one ever really tells you what it is, how it's calculated, what it's important for, what it's not important for. So that's what we're going to do today. This whole episode is about credit scores. If we haven't met, my name is Connor. I own Locker Room Finance, a financial education company I built just for student athletes. We provide this financial education in a way that athletes actually enjoy so they can win with money. Athletes want to win, and I help them do that with money. So what is a credit score? It's a number between 300 and 850 that is given to you by credit bureaus that tell lenders how risky you are when it comes to borrowing money. This could be a bank, credit card company, mortgage company, any place where they lend money and you're the one that's going to borrow it. They want to look at your credit score to see how likely it is that you will actually pay back that money. The higher your credit score, the more trustworthy you seem to the lender, the more they think that you're actually going to pay them back. The lower your credit score, the less trustworthy you seem to these lenders, and the less likely they think it is that you're going to pay them back. Now, you really have a few different credit scores. There are a few different companies that calculate your scores, but the most common way your score is calculated is what's called the FICO score. So if you've ever heard about your FICO score, this is how your FICO is broken down. It's in 5 different categories, and it's payment history, credit utilization, length of credit history, sometimes they call it credit age, credit mix, and then new credit or inquiries. Now we'll go over those again. So your payment history is 35% of your credit score. That means, do you pay your bills on time? And if you pay your bills on time, your payment history portion is going to look really good on you. If you ever miss a payment, then it's going to ding your score quite a bit. So the most important thing by percentages is to pay your bills on time. Never, ever, ever miss a payment. The next highest percentage is your credit utilization. This means how much of your available credit are you using? What is available credit? Let's say you have a credit card and it has $1,000 limit, and that's the only credit that you have. Then you have $1,000 credit limit. Now your utilization is how much of that $1,000 you're actually using. If you spend $500, that's 50%. If you spend $1,000, that's 100%. With your credit utilization, it looks good on your score if you keep it less than 30%. So on that same $1,000 example, it would mean don't spend more than $300 of that available credit before you pay it off. Some people think that if you have $1,000 credit balance, that for some reason it looks good on your credit score if you spend the full 1,000 and then pay it off. That's not true. They want you to keep your utilization low relative to how much available credit you actually have. There's another myth going around about credit cards that you should carry a balance from month to month, and that is usually tied into utilization. So the 30% that I said, that is what you don't want to spend more than. Do not spend over 30% of your credit, of your available credit, before you pay off your card. Now, that's gotten twisted by some people, I'm not sure why, to say that you should leave a balance of 30% on your card month to month. So in the same example, if you have $1,000 card, some people say if you keep $300, 30% as a balance and you don't pay it off every month, that will help your score. That's absolutely false. I don't know why people say that. All that's going to do is make you pay more in interest, and that's what we don't want to do. So 35% is your payment history. 30% of your score is your credit utilization that we just talked about. And now 15% of your score is your credit age, the length of your credit history. So if you are a new person to credit and you've only had a credit card or a student loan or a mortgage for 6 months, then this 15% of your score won't look as good as someone that's had credit for 20 years or 30 years. So the longer you have accounts open, the better. So even if you only have one credit card, but it's been open for 5 years or 10 years, that will help this little 15% of your score. Some people get scared by this and they go open up a credit card right away, even before they know how to use it or what they're going to use it for, just so that they can have that history starting from when they're 18 years old or as soon as they hear about credit. I would caution you to do that. The length of your credit history is important, but again, it's only 15% out of the 100%, so it's not that important, and I would never encourage someone to jump into a car loan or credit card or something just so that they can start their credit earlier. I would encourage you to do that smartly and wisely when you're actually ready for everything that entails. The remaining 20% is broken up into 10% of credit mix and 10% of new credit. Credit mix refers to how many different types of credit you have. Now, again, this is only 10%, and this one is very not important, okay? But ideally, to the credit bureaus, you would prove that you can borrow money from a lot of different places and pay all of them back. So that means a credit card, a mortgage, a student loan, a car loan, a personal loan, like all of these different types of loans. If you can prove that you are good and consistent at paying back a lot of different people, then your score will go up, because that means anyone else that you borrow from in the future, you're probably going to pay them back as well. As opposed to someone that only has, let's say, one credit card, they haven't proven that they're able to pay back a whole bunch of different people. And so this little 10% will be a little bit less in their credit score. But again, this is not as important as pay your bills on time and don't use too much of your available credit. Those are the two things that are really important, but your credit mix does play a factor into this. I'll tell you, in my life, I only have 2 credit cards and a mortgage. I don't have anything else, and my credit score is just fine. And I never worry about my credit mix. I'm not going to go get a car loan just to increase my credit mix. That's not the way that I would use credit. The last thing is new credit and inquiries. So this is actually something that can lower your score. If you're applying for new credit often, then you get what's called a hard inquiry. That's a tough word to say. Inquiry. Am I saying that right? You get a hard inquiry on your credit report, and that could ding your credit score. That could lower your credit score. What this means is the credit bureaus don't want to see you applying for tons of new credit lines at the same time. So if you're going to be applying for credit through loans, credit cards, mortgages, it's a good idea to space those out over time, especially if you are about to buy a house. Mortgage lenders usually tell people to not open up any kind of new credit cards, buy new cars, don't do anything like that within 6 months or so before buying a house, because that could potentially lower your score quite a bit. So that's how your credit score is calculated. From most important to least important on the calculation side of things, it goes payment history, credit utilization, length of credit or credit age, then credit mix, and then new credit or inquiries. Now, once you have this score, what is it actually used for? Because a lot of people stress about getting their score as high as possible. Your credit score is only important when you're borrowing money. So if you're someone that plans on borrowing a lot of money, then your credit score is really important. If you're someone that chooses to live a life where you don't borrow much money and you only borrow when you need to for things like houses and maybe a car, then your credit score is not as important. So your credit score is used for when you get approved for loans like cars, houses, credit cards, and it decides your interest rate. Let's say you go to apply for a car loan and your credit score is higher, they will give you a lower interest rate. So it'll be cheaper for you to borrow that money. Remember, interest is the cost of borrowing money. So high credit score, low interest rate. And the same is true the opposite way. If you have a low credit score, they will give you a higher interest rate. It'll be more expensive for you to borrow that money. Here's an example on a $20,000 car loan over 5 years. Disclaimer, I would never recommend to borrow money for a car unless you absolutely have to. The best way to buy a car is with cash. And that's how I bought my car. You save up money, you go find a car you want, and then you pay for it. Okay. Car payments keep people broke, and I don't want you to be broke. If you do need to finance a car because you can't afford one up front, find a used car that's reliable and 3 to 5 years old, and then use what's called the 23/8 rule. This is from a show called The Money Guy. So 23/8, 20% of a down payment. The 3 means don't finance it for more than 3 years. And then the 8 means it shouldn't be more than 8% of your total income. Now, I know as student athletes, that might be difficult for us to calculate because our income is irregular. Maybe we don't have any. The best car you can drive in college is a paid off car. Any way you can get a paid off car, that's the car we want to be driving, even if it's not the prettiest car. I drove a 1999 Buick Century all throughout college. It didn't have AC all the time, didn't have Bluetooth, didn't have Apple CarPlay, but it was just fine. And it got me from point A to point B, and I survived. So the best car you can drive is a paid off one. Back to our example about how your credit score can affect your interest rate and the amount of interest that you pay. So this example, $20,000 of a car loan over a 5-year period. Now, this comparison is going to be between three people: someone with a 750 credit score, which is pretty good, someone with a 600 credit score, and someone with a 500 credit score. Now, the 700 credit score person, they might get an interest rate of 4%, which is pretty low in the car industry. Their monthly payment would be $368, and then the total interest paid over that 5 years would be $2,100. So they had a $20,000 car loan paid off over 5 years. Their monthly payment was about $370, and the total interest was just over $2,000. Our next person with a 600 credit score, they might have an interest rate of 12%. So a 3 times higher interest rate than the person with a 750 credit score. Now, this person at a 12% interest rate, their monthly payment would be around $450 a month, and the total interest paid over the 5 years paying it off would be $6,700. So more than 3 times as much interest because their credit score was a 600 instead of a 750. Now down to 500, which is a pretty low score. Anything around 500 or below, you might not even qualify to get a car loan. But let's say that you did. You would likely get an 18-ish% interest rate, which is very common with poor credit. Now, this 18% interest rate, you'd be paying $500 a month, and you would pay over $10,000 in interest over the 5-year period. So let's compare the 500 person to the 750. So the person with 750 credit score, they only pay $2,000 of interest. So the $20,000 loan cost them $22,000 over 5 years. Okay, so the loan plus the interest, $22,000 over 5 years. Now the 500 credit score person, they're paying $10,500 in interest. So the same car cost them over $30,000. So more than $8,000 more than someone with a good credit score. So I hope this example drives home the point that with a better credit score, you pay less in interest, and then it's easier to purchase things. And then it's less stressful on you financially because you're paying less interest if you have a higher credit score. Now, what if your credit score is too low to qualify? I've talked to people before that moved out of apartments and didn't pay their last month's rent, or they stopped paying on a credit card, or they have a lot of things in collections, and their credit score is down in the 400s. And in this case, you might not qualify for a car loan. Lenders could deny you altogether, even if you have a job and steady income. You might need a co-signer. You might need a larger down payment, or you would definitely face higher lending risks. So a co-signer means if your credit score is too low that they won't lend you money to buy a car or anything else. You might have to have a co-signer like a parent or someone to sign and say, I know their credit score is low, and so if they don't end up paying you back, I will step in and pay them back. Now, you might need a co-signer early on to get a first credit card, or if you need a car in a tough situation, but co-signers are usually not a good idea because I would hate for my parents' financial lives to be ruined because I messed up. And I've heard this story before. I talked to an athlete who didn't pay their last month's rent, and their parents were co-signers on that. And then when their parents went to try and buy a new house, they literally got denied because their credit score was so bad because their son had a bad credit score and they were co-signed on a lot of his things, like his apartment and his car, things that he had stopped paying on. So be very, very careful about having someone co-sign for you. And if you are a student athlete listening to this, definitely you're not in a position to co-sign for anyone else. I would never recommend that. Now, there are some really predatory things out there, especially in the payday lender area and the car loan area, especially, car specifically. If it says nothing down, no credit check, run the other way. There are some horror stories out there where they'll give you 20-30% interest on a car, and then you'll be paying $400 a month for the next 15 years of your life. And that's like so long that the car, you literally won't even be driving it anymore. So if anything says nothing down, no credit check, it's probably a scam. I've even over Instagram, I've reached out to some people that run these lots. And it's funny, whenever I message them, they don't respond back with text. They respond back with a video message so that I can't screenshot anything. And they literally say, come on, man, it's going to be 25-30% interest. Like, if you're not putting anything down and you don't have any credit, then we're going to charge you a whole lot of money because you probably can't afford it anyways. And so they know you can't afford it, but they're still going to give it to you anyways because they make so much money off of that. So the bottom line, your credit score doesn't just change what you qualify for, but it changes your entire financial reality. If you end up having to pay more in interest for things, your life will be more difficult than someone that pays less in interest. For example, a home mortgage. If you have a 7% interest rate versus a 5% interest rate, that is tens of thousands, if not hundreds of thousands of dollars of a difference over a 30-year mortgage period. So your credit score does matter when it comes to borrowing money. But your credit score does not matter for a lot of other things. Here's what a credit score is not. Your credit score is not a full picture of your finances. I know people that have credit scores over 800 and have $0 saved in the bank. But their credit score is really good because they pay their stuff on time. They don't spend too much in their utilization. They have a bunch of different lines of credit, but they have so many lines of credit that they don't have any money left over every month to actually save or invest. So your credit score, again, is a very small part of your overall financial picture. I care more about, do you have a savings account? Do you have an emergency fund? Are you intentional with your spending? Do you know your income? Do you know your expenses? Your credit score, yes, is an important part of that. But in my life, my credit score has not been as important as, do I have savings? Am I investing? Have I saved to buy a car? Have I saved to go on vacation? My credit score has not been that important. And that would be my hope for you, that you manage your finances well enough that your credit score is not the only determining factor of if you're successful financially or not. Yes, it does matter, and a higher credit score will make your interest rates lower. But other than that, your credit score is not the most important thing in your life. It breaks my heart when I see people that are so focused on getting a high credit score that they go into unnecessary debt. They open up unnecessary accounts just to increase their credit score, when in reality, you might not even need to borrow money for something if you would have just saved instead of focusing on your credit score all the time. Credit is a tool. It is not the entire toolbox. It is one piece of your financial life. So how do you find your credit score? You might actually already have a credit score even if you don't know it, especially if you have student loans. If you have a student loan, or you've opened up a credit card, or you've been added as an authorized user on one of your parents' accounts, then you probably have a credit score. You should download a credit app like Credit Karma. That's one I use, or Experian. And this, you can check your credit score. It's free and it will not hurt your credit. Using apps like Credit Karma to check your score, that will not lower your credit. That's not a hard inquiry. That's just you knowing what your credit is. There's also some free credit score stuff online provided by the government, but Credit Karma is kind of the standard. Advice for if your credit score is low. First step, identify the problem. Have you been missing payments? Have you stopped paying on something that's in collections? Like, what's the reason for this? And then focus on that problem. If you've been missing payments, start paying them on time. Identify the problem, and that'll help you know what to do next. This is for everyone, but especially if you have a low score, pay your bills on time. Always set up auto pay for every single account that you have so you never miss a payment. If you have something in collections, which means you've stopped paying on it, and the company that you stopped paying, they have sold your debt to what's called a debt collector, and now that debt collector is calling you trying to get the money back. So if you have something in collections, you definitely want to get that paid off as soon as possible. It might take up to 7 years for that to fall off your credit report. It'll be negatively impacting you for a long time, but better to get that taken care of now than just letting it hang around. Short note on collections. If something is in collections, and I would not recommend to let something go to collections for this reason only, please don't. Just pay your stuff on time. But if you do have something in collections, you can settle the balance usually. Let's say you have a $2,000 loan and you stop paying on it, so that company sells it to a debt collector. They'll call you and they'll ask for $2,000. Usually, if you say, hey, I've got 1,100 or 1,500 and I can give it to you today, will that settle the balance in full? Usually they'll make a deal with you. Because it's in collections, they're really betting on you not paying it at all. So if you give them an offer that is lower, sometimes even half as much, they might accept that. But if you're going to do that, before you send them the money, get it in writing in an email that says, the balance is $2,000. We will settle that balance for $1,400.50 or whatever it is, but get it very specifically in writing before you ever send the money. More things to do if your credit score is low. Keep your utilization down. A lot of people's credit scores are low because you have a $2,000 limit on a credit card and you have it all the way maxed out at $2,000, and you pay a little bit and you spend more and pay a little bit. If your score is low, it might be because you have a maxed out credit card and you're spending too much. Again, the goal is to keep it under 30%. More tips. Don't apply for a ton of new credit all at once. We've already talked about that. And then time helps in this world. In the world of credit, making your payments on time keeping your utilization low, not going crazy with your credit. Just do those simple things year after year after year, and your credit score will go up over time. Personal story from my life. This is just my own experience with credit with a few things. After I graduated college, I had a credit score. It was 680 maybe or so. I didn't even really know I had a credit score, but I had student loans. And if you have student loans, and that is a debt, and then you have a credit score. And I decided to pay off my credits. I decided to pay off my student loans. So I paid off 22,000 in student loans in 3.5 months. There's a whole nother podcast that I told that story. But after I paid off my loans and my wife and I got married about a year later, we didn't have credit. So if you don't have any accounts open after about 6 months, you kind of become invisible to the credit bureaus. And so for the first 2 years or so of our marriage, we straight up didn't have a credit score. And that was okay in our life because we weren't borrowing any money. We didn't have credit cards. We didn't have car payments. We hadn't gotten a house yet. And so we were okay with not having a credit score because we didn't really need one. Some people say you need a credit score to rent an apartment or something. You don't need that. My life was fine without one. And we just didn't borrow money. So we were saving, we were investing using debit cards only. And so we were invisible to the credit companies. Then we went to buy a house, and there's something called manual underwriting, which is the way they used to do home loans a long time ago before credit was really a big thing. And through manual underwriting, we were able to apply for and we were approved for a home loan. And it's actually worked for us. There aren't many companies that do it, but one company that we went with, they were able to do it. And so instead of just looking at our credit score, debt to income ratio, and a few other things, they looked at our entire financial picture to be able to identify if we were ready to purchase a house and if we would actually be paying them back. And it worked because we had pretty good finances and we had good documents of everything. And so they approved us for a loan. Then before we ended up actually buying the house, because you get approved for a loan and then you find the house you want, and then that's kind of how it works. And so before we actually bought the house, President Biden announced that student loan forgiveness was a thing. And I had already paid off my loans, but I was like, hey, they said that if you've already paid off your loans during the COVID time, that you could potentially get your loans forgiven as well. But since I had already paid back my loans, I had to apply for a thing. And so when I applied, I thought I was applying to get reimbursed $22,000 if it went through. What I didn't realize is I was just applying to get all of my student loans back. And so they just gave me a loan of $22,000. And silly me, I didn't really realize what they were doing. And so suddenly I had all my loans back, and that triggered a credit score for me. So now that I had a credit score and we were about to buy a house, we called our lender and talked through it, and they had to redo it because if you have a credit score, then they have to use that credit score. But if you have no credit score, they can do manual underwriting. But since now we had a credit score, it was 740 or something, 730, because I never had any late payments or anything. And so it was a decent credit score. And they went and they ran the numbers, and we ended up with about the same interest rate anyways. I think our interest rate with our credit score was a little bit higher than without it, just because our finances looked pretty good, but then with the score it was a little bit lower. I don't remember exactly everything that happened with that, but all I know is that we got approved for a loan without a credit score. Then I ended up getting a credit score because of the student loan thing, and then we reapplied and we got approved again with a credit score. Today, I have a credit score of about 780, and I'm fine with that. I could work to get it higher, but I don't really need to because I'm not really in a place where I'm going to borrow money. We have a mortgage now, and we have 2 credit cards, and we pay all of our bills on time. Everything's on auto pay. Our utilization on our credit card is usually around 10%. A hack for utilization, but only do this if you are able to manage yourself well. You can call your credit card company and ask them to raise your limit. So let's say you have a $5,000 limit. You can call and ask them to raise it to $7,000, and then that will make your utilization look better. Do not do this if you're going to raise your limit so you can actually go spend up to that limit. But if you want to make your credit score look a little bit better without a lot of work, ask them to raise your limit, but then still spend the same, and that'll look better on your utilization. So for my wife and I, we pay our bills on time. We don't use too much credit. We don't do all the hacks. We don't obsess about it. We're just consistently doing the right things and paying our bills. And that's worked for us. Now, a lot of people have different credit stories, and there are a lot of different situations out there that are unique situations, and you might have to, strategize them a little bit differently. But if you're someone that has not really done a lot wrong with credit and you haven't gotten yourself in a tough situation yet, my advice to you, pay your bills on time, keep your utilization low, and you'll be fine. Okay. And you'll have a credit score in the 700s, and then you'll get approved for most things at a low interest rate. People on Team LRF, we don't stress about credit scores. It's not the most important number in our financial life. We care more about building savings, spending wisely, setting a strong financial foundation for ourselves. And we know that credit does matter, but we recognize that it's one piece of the puzzle, not the entire picture. If you have more questions about credit or you want my advice on your specific situation, go to Instagram at lockerroomfinance. Send me a DM. We can talk about your credit situation. I'd love to help out however I can. But my final advice on credit, and I've said this over and over again, and I'll say it again because I want this to be the thing that you remember from the whole episode, is pay your bills on time. Every single bill, put it on auto pay. Pay your bills on time and don't use too much of your available credit. If you have a credit card with a $500 limit, spend $50 on it. I guess the math would be $150 would be 30%. So don't spend more than $150 before you pay it off. If you do those two things, you pay your bills on time and you don't use too much of your available credit, your credit score should be just fine and you won't really have to worry about it. Credit's something that I'm sure you can tell by this episode, I don't worry about my credit at all. And I want that for your life as well. I track my credit. I look at it maybe twice a year, but I don't stress about it, and I don't want you to stress about it either. So don't feel like you're missing out on something if you're not some credit guru. We want to focus on things that matter, which is saving money, investing someday, staying away from a lot of debt. Hope you got a lot of value on this episode about credit. Again, I made this episode because a lot of people talk about credit, but it's kind of a vague thing. And a lot of people don't know how it's calculated or what it's for or what it's not for. Thank you for listening to the Locker Room Finance Podcast. We'll see you next time.